Okay, so now that we've learned to identify the business income or gross income and deductible expenses, now we're going to look at how do we match income to specific periods. So income in the right period and deductions in the right period. And so there's different accounting methods that we have to look. First of all is we have your annual period, which hopefully we all know that an annual is going to be a full 12 months, or what we can call a short tax year, which is less than 12 months. A calendar year ends on December 31st, matches the calendar. But a fiscal year can be whatever a company sets up. It's the last day of their month. It does not have to be December. And actually, it can be any day of any month end that they choose. There are typical months that companies end. March 31st, April 30th, kind of, June 30th, October 31st. Those are very common month end. Why would March 31st be a common month end? What did we just get through? If I told you that clothing and stores like Target have a month end of March 31st, what did we just finish with? The holiday season, right? If you were a company like Macy's or Target, do you want to get through Christmas and have that be on your annual report? Yes. So you need to get through Christmas, you need to get through returns. March 31st is your year end. June 30th is a lot of just overall businesses, a lot of manufacturing companies. Some also have a September 30th year end. And then others, just July 31st is also one. It just depends. June 30th is smack in the middle of the year, though, so a lot of them pick that. December 31st is a calendar year, which companies go with, but also think about the fact that if your year end is December 31st, that's also when you're working to close different things. So that's kind of a bummer year end time to do. Not that that necessarily affects when they're going to do things, but all right, accounting period. A proprietorship is the same as a proprietor, and we know C Corps or C corporations are the same as individuals, and the choice is made on their tax return. So you get to choose when you file your tax return and you're filing a Schedule C, you get to say when your tax year ends. Normally, you're going to choose the fact that you're filing a Schedule C. It's going to end when your tax return ends because you're filing as of December 31st. Flow-through entities have a required tax year, and that it has to match their owner's period. Multiple owners of the partnership can make that very difficult. All right, so now let's go in, and now let's look at problem 23 and ask the question, how does an entity choose its tax year? So what did we just say? How can a company choose its tax year? Does it matter? What did we just say?
Well, it sort of matters, but it doesn't really. Because you're going to have 12 months, doesn't matter. You're still going to have that whole holiday period in there.
Right. But the reason that some of those merchandising companies, let's call them that, with Target and Macy's and those type of companies choose shortly after Christmas is they haven't had the downturn of a slow season. They just had the upturn of a busy season. They always have 12 months in them, like you said. But the busiest season for them is the holidays. So they end on a high note. Then they get to go through and suffer through the rest of the year and hopefully end on a high note. You don't want to end on, let's say, May 31st or June 30th on going through a slump. Filing your taxes or filing your annual report in a slump is never a good thing. Your investors don't want to see a downturn, they want to see an up. Now obviously having a bad holiday season isn't going to be a positive thing either, but no one goes into it thinking the holiday season is going to be bad. So a company gets to choose their tax year, and then it says, is it the same process no matter the type of the tax year end the taxpayer adopts? So does it matter? Does it matter the type or tax year end, I can't talk tonight, that we adopt? So once we pick one, do we have to stick with it? Unless we get permission from the IRS, we got to keep our tax year. You can't just go in there and randomly start changing your tax year because you're going to have a mess with your taxes. If my tax year ends on March 31st and then I decide I want to change it to June, what am I going to do with those couple of months between March 31st and June? Am I going to file a little tiny tax return, or am I going to file a 15-month tax return? You can't do that. So you do need special permission from the IRS. Let's see. All right. Well, then the last part of these slides are what I kind of talked to you guys about, the different types of accounting methods that are really kind of a little bit advanced for the class. So why don't we go ahead, and there was one more problem I wanted to work. This comes more with calculating the after-tax part of payments. So when we're looking at amounts, so this actually is applying the business cost. So why don't we work problem 54, and then we'll circle back and see how much time we'll spend on the accounting methods. Okay, so let's take a look. It says, assume Sarah is a cash-based calendar year taxpayer and she is considering making the following cash payments to her business. Calculate the after-tax of each payment assuming she has a 25% marginal tax rate. So it says $2,000 payment for next year's personal property tax on her business. So what is going to be the after-tax of the $2,000 payment for her property tax for next year? $1,500. Yeah. So we're just going to take the $2,000, take 75% of it, and she can deduct the whole amount because it's in the next year, right? All right. What about, it said $800 to reimburse the cost of meals by employees while traveling for business. What are we going to get there? Cost is going to be $700. Okay, so how we got that was we had to take 50% of it. Wait a minute, let me do that backwards. 1 minus 50% of 25%, which is the marginal tax rate, which got us $700. So we only get to get 1/2 of it is deductible. All right, and then $1,200 for football tickets to entertain out-of-town clients. What are we going to do there? Same thing. 1,050, right, same thing. Same process because it's entertainment, it's 50%. And then $500 contribution to the mayor's reelection campaign. So they're going, nope, nothing. All right, no campaigns of any kind. All right, nothing. We want to try, but we can't do it, right? Okay. So the next couple slides, I'm going to just go through really quickly. A couple of them I'm going to probably skip. A few of them are financial in nature, and because you don't have to have financial accounting, even if you had financial accounting, you might have had it a while ago. We're just going to touch on a couple of them. A couple things to think about when you're doing financial versus tax. Financial accounting is very conservative. Okay, I talk about that in my class. The approach is always to go low, right? To estimate very low income, and then if it's high, everybody loves you. To estimate low profits, right? Everybody loves. Okay, tax is much less conservative, right? From a tax approach, you're very quick to recognize income because it's the other way around. You recognize your income to pay the tax on it, versus not recognizing income because you don't want your investors to think you're doing better than you are. So they kind of have a little different of an approach. All right, tax is very less conservative than financial. The accounting methods are still the same. We got cash, we recognize it when we get it. Accrual, which is recognizing income. Remember, if you haven't been in financial for a while, accrual is recognizing income when you earn it and expenses when you use them. All right, cash is just when you spend the money. And the hardest thing with accrual-based accounting for most people is they want to recognize it when cash is spent or cash is earned. And I can sit there in class, give an example, everybody get it right, hand out a multiple choice question, and people get it wrong. Because they want to use cash. They want to do it with cash. Because you and I operate cash. Our lives are cash. If we don't have the money to pay a bill, we don't pay a bill. It doesn't matter that we used it this month, we can't do it, all right? So, and then a hybrid is a little bit of both. All right, so the methods for tax are adopted on the first tax return. Large corporations usually have to use accrual. Cash method, we just kind of talked about it. It's flexible, it's inexpensive, it's simple, it's not GAAP. Taxes don't have to be GAAP. That's the nice thing. Taxes can do whatever because you and I do our taxes and we're not GAAP. All right, but companies that file with the SEC have to be GAAP, so therefore they have to use accrual-based accounting. So their financial returns will be accrual-based, their taxes will be based on their income, right? So income is recognized when earned or received. So they're going to be paying taxes. That's why it just kind of showed income taxes, cash, accrual, or mixed, because companies that recognize their income on accrual base are going to be putting their income on their tax returns as they recognize it, which is going to be based on accrual. You and I are going to be putting our income on our tax return based on our W-2, which is going to be when we got paid. Right? So all events are recognized when the events have occurred, which fix right in with the income. It's reasonably accurate. Earliest of these dates, completed service, payment is due, or payment is received. So that's accrual based. Okay, where's my accrual question? There we go. All right, so Ben provided consulting services and bills ACE $12,000. ACE disputes the claim that then says it's $8,000. How much income should Ben recognize under accrual-based accounting? Should it matter that ACE is disputing it if Ben provided the services? What does accrual-based accounting say?
We recognize it when we earn it, so it's 12,000.
We recognize it when we earn it, so it's $12,000. Now, if the dispute happens and it gets changed to 8, then we're going to have to go back and make an adjustment. But based on the recognize it under the accrual method this year, and a lot of it's going to be timing too. If this happens in February, might not be an issue this year. So they don't put any dates on this question, which I thought was interesting. But so advance payment for services, you can defer recognition for 1 year unless income is earned or recognized on the financial records. All right, just depends on how we're doing on prepaid. Advance payment for goods, you can elect 1 or 2 payments of recognition. These 2 things right here, and you're talking about the advance payment, that's really where we're taking it a little bit more into the advanced. Okay. And you're just not going to see it. The accrual and cash is what I really wanted to make sure you guys understand, because you do need to understand it. You need to understand that your tax return can be both. Even though we're doing individuals, as soon as you jump to corporations, corporations are usually accrual based. And technically, a Schedule C can be accrual based. You get to choose on a Schedule C if you want to be accrual or cash. It's just depending on the complexity of a Schedule C, most are cash based businesses. Yeah?
In S corp, we can choose between the cash or the accrual basis.
I'm going to answer with I believe so. I am not that good with S corp, so I don't want to give you a 100% answer and be wrong. But I believe that you can choose on an S corp, because an S corp should be very similar to a corporation and a Schedule C. The only difference is that they're limited in the number of shareholders to 100. As soon as you go over 100, you become a regular corporation. So there shouldn't be any difference in the financial of whether it's accrual. And the difference there is going to be, obviously, when you're under 100 shareholders, you probably are not going to be publicly traded. Therefore, you don't have to be GAAP, and therefore you don't have to be accrual. So you don't have to choose accrual, whereas corporations that are publicly traded do. But I would still think that you have that. There would be no reason that I could think of off the top of my head that you would have to that you would not be allowed to choose one or the other. All right, Ben provided dancing lessons. This is just a real, even though the explanation on the prior slide was long, I think this makes a little bit more sense. Ben provided dancing lessons on September 30th of this year and received the full $2,400 for 2 years. How much income does he have to recognize under cash and how much under accrual. So we already did this cash example. What did we say if it's for 2 years income, if he got it all right now, how much would he show on his taxes? If you got $2,400 right now, what would you show on your taxes?
Cash based, you show the 2,400.
Okay, so what would he show on his accrual base?
2,400.
So we're saying 2,400 on both? What if I say one of those is wrong? I hate when he does that. All right, so he cash based, it is the 2,400, but accrual based, all right, he's only going to recognize 300 this year and the rest next year. So it's going to be 24 months, so it's $100 a month. Only 3 months of it falls into this year because it's that whole calendar year thing. He cannot recognize more than what's going to happen within the next 12 months. So much of that is going into the next one, so he's going to have to defer the rest of that income into the next year. So he was only going to be able to recognize that. But cash base, you're absolutely right. If we get income this year, it's our money. And we have to. Someone pays you, $4,000 for income you're getting, or for something you're going to do next year. It's going on your tax return right now. You might not do the job till next year, but it's showing up on your tax return. Again, that's advanced. Inventories get into advanced. Now, it doesn't mean, and again, the reason I want to show it on here, it doesn't mean that you wouldn't have inventory show up on a Schedule C that you might get. The detail in which the inventory shows up becomes a different amount. Is it accounts receivable? Is it sales with accounts receivable? Or is it just somebody carrying inventory? Carrying inventory on a Schedule C does not all of a sudden take it from a moderately difficult tax return to this excruciating hard tax return. You can have inventory. How much do you have on hand? Oh, about $4,500. No. Okay, that's not a hard inventory. Some of these can get very difficult. So you gotta judge yourself when you're looking at it. You still have an inventory, even just on a Schedule C, first in, first out LIFO, and then specific identification. Now, LIFO is used on a lot of tax returns. We talk about this in financial because it usually generates the lowest amount of taxable income. So a lot of people like to use LIFO on their tax return. And then accruing business expenses, this is the last few slides here. It's called economic performance has occurred. We're looking at all events that kind of are going to test the reliability of the asset. This again gets into a little bit more complexity of whether or not the taxpayer is using the goods, how they're using the goods, how the payments of the liabilities are taking place. This goes just again above, a little bit beyond. You can kind of see I left these steps in here. I left the examples in here if you want to take a look at it. This last slide I do like. It talks about liability and economic performance, and then whether or not you can capitalize it, which we talked about, right? Spreading it over life. Whether or not you deduct it, okay? Remember the 12-month rule. Otherwise, we deduct it, and then whether or not we completely disallow it, which is our meals and entertainment. If it goes over 50%, it's disallowed, or in some case, lobbying and those type of things, clubs dues are disallowed completely. So when you're doing a Schedule C, I want you to understand that there are people that you can do a Schedule C for that will be easy. And Zaid knows the ones that we did here for VITA were very easy. All right, we did a couple people's that you'd be like, that's really a Schedule C. I mean, that's how easy their Schedule Cs are. Then there's some very mediocre Schedule Cs. Again, I made the example of the Advocare. I know several people that sell things, whether it's Mary Kay or Advocare or whatever the newest and greatest thing is to sell and get rich at home. All those things, they do those things on the side, jewelry. Those are all pretty easy things to do a Schedule C for. Some of them are harder than others. The more money you make, the little bit harder it gets. If you employ people, you're going to get harder. But you can get into a very complex Schedule C. And I don't think people realize how hard a Schedule C can get. You can have a full-blown business with lots of employees, a full-fledged inventory. You can have wages and insurance and You can be paying health insurance. You can do all that and have it go on a Schedule C that flows through your own tax return. You can. Does it make a lot of sense? Well, if you're not a corporation, I mean, you could be an LLC that flows that way. You know, it just depends. It just depends how you have your company set up. If you're not a partnership and you own it by yourself, still could be a Schedule C, a very, very big Schedule C. If you don't, it just depends on how you have yourself set up. So there, you could be that big. It just depends on how long you stay your own owner, really. How long are you the only person owning that business and you have people working for you? And a lot of companies, as they get that big, no longer are their own owner, singular owner. They end up even just families own them, and then they're no longer a Schedule C, they're a partnership. You gonna say
So if
something?
you're a sole proprietorship and you get bigger like that, do you have to do a Schedule C, or is there an option?
Well, Schedule C is a sole proprietorship. You do that if you were.
So if you got crazy big as a sole proprietorship, you're like the top dog.
You're
the
still a
only
sole
guy,
proprietorship,
you're still-
but because you're a sole proprietorship, you could have 100 people working for you.
Right.
You're just the
But
only
it's all gonna go
owner.
under the Schedule C and flow into
It's
your
going to be under
personal.
Schedule C, and it's all going to flow to you.
Yeah.
Right. You're just making a lot of money. You know, it just depends on how you have it set up. But you know, as a Schedule C, an LLC is a limited liability corporation. A lot of times, as you get bigger, you're going to incorporate yourself to protect yourself. So that's sometimes why as they get bigger. Now, there's different laws regarding Schedule Cs, corporations, and LLCs. Then you get into legal issues, which I'm not as familiar about. But I have friends that are very, very small, and they are LLCs. But it's still a Schedule C that they flow on. So, you know, Schedule Cs, LLCs, they all still flow the same way. He's a web designer, but he incorporated himself to protect himself in case he did something wrong. You know, so. Okay, so we are done. So we know that the Chapter 9 homework is due by Monday night. Your exam will open up on Tuesday at some point. Tuesday I'll send out an announcement when it's out there. It will be open for roughly 5 or 6 days, probably through Sunday. I mean, I don't care if it's open until Saturday or Sunday, so I'll probably just leave it till Sunday. And then your research project will open at some point either Tuesday or Wednesday as well. And it will be open for basically 2 weeks since we don't have class on the 18th. And that will be open until we then come back and start with Chapter 10. Now when we come back on that 25th, make sure you have that Learn Smart book done for Chapter 10. Some of the chapters, the second part, are harder. Some of them are just exactly the same. We just get into a few things like Section 1231 and 1245 losses and investments that sometimes are a little bit more like this, a little bit more advanced.